You don't wake up knowing markets, kid. Everybody starts brand new. First you learn what moves, what waits, and what risk can really do. No racing clocks, no magic tricks, no get rich overnight. Just learning how to place a trade and sleep cozy and tight. No shortcuts, no loud claims, just rules you understand. Know what you're risking, know your why. Keep a steady hand. One trade at a time, that's how it's done. Slow is smooth and smooth is smart. You learn before you earn, my friend. That's how confidence starts. This ain't a sprint, it's a longer game. So pull up a chair and plan. Welcome to Options for Beginners with Dan.
We're back at it, Dan. How you doing?
I'm doing good. Well, welcome everybody. Glad to have Troy with me today, and continue to have fun doing this. And again, for the beginner class, you know, the whole philosophy here is try to get, you know, some knowledge or information on some of this stuff, and then practice. You know, it's like one of those things. This is a craft that it has to be a combination of info and doing. And so today, a little different. We're going to take a little bit of a detour from, we've been talking about the wheel strategy the last week and a half, a little bit with some examples, just getting you a little comfortable with that a little bit. Not that we'll come back, but today I thought it was something a little different. Triggered by Troy was talking about, you know, a little bit higher volatility in the morning, until we've rallied 45 points here and volatility is going down, but a little bit higher volatility. So it was giving me the idea of, and also Troy was talking about, you know, different durations. A lot of people in the OO community will do 0-day credit spreads and stuff like that. And that is wonderful. But at least maybe explore a little bit today, maybe contrast. Number one, I was going to contrast a credit spread for Monday with a credit spread 21 days out, and just to get a real good feel what that's all about and what are the differences and what does it mean. And then I'm going to go into just talk about a little bit a 3-week butterfly and just go over that real basic. And then we're going to finish with, if we have the time, a quick shot, just because everybody's thinking, okay, what's going on in Iran? Well, what if you wanted to take a little shot there, a cheap shot there, if the Iran thing kicks in this weekend? But everything is going to be through the lens of, hey, a beginner trader. And so all of these trades are going to be $400, maybe $450 or less, right? So it won't be something like, okay, Dan, you're putting a beginner in a $3,000 trade. No, it'll be basic, and you just get practice with it. So that's it. Without further ado, Troy, should we jump in?
Let's do it. And as always, technology between Dan and I struggle sometimes to switch back and forth, but we're going to do it today. We're going to make it work. So Dan, I'm going to let you share your screen.
Yeah. All right, so I
see you moving stuff. I see you moving it.
All right, so then I don't need to share. I'm sharing, right?
Yeah, you're good. You play around in option.
If I just click, you see that, right? I just clicked that. All right, we're good. The only thing I'm going to do, Troy, as we start, the sun is blaring in my window here because it's a wonderful problem to have.
It's a beautiful day.
We have sunshine, so I'm going to have to close the blind so I can see the computer a little better because it's in black. So let me just close the blind and
for those, Dan's being kind. Really, what he's saying, it's not the sun blaring; it's the amount of Lambos that he has on the other side of the computer. He keeps his Lambos. Oh
yeah, the only Lambo that I have would be like a Lambo sandwich, which may be maybe a lamb sandwich or something. That would be, but thanks, you try.
Yeah, for sure.
Yeah, so let's jump in. So the first quick segment is credit spreads. I mean, would you say, Dan, that's a basic strategy for a beginner? Yeah, I think just because it's two legs, right? So I'm going to throw one up here. So I'm going to contrast a couple. So what if and none of this is a recommendation, we're just going to talk about it. So let's say first step, I'm going to look at a butterfly for Feb 23. And you say, Dan, when's Feb 23? Feb 23 is Monday, right? So we're going to look at a basic credit spread here, and I'm going to sell like around a 20 delta. So I'm going to sell the 66 30 puts, and then I'm going to buy against it. So 66 30 puts are about a 20. Wait, where am I at here? 3 days out, 66. Okay, I'm sorry. 3 days out is a 68 30 put. Okay, so you can see how easy it is to scroll up there. So I'm going to sell the 68 30 puts. It's around $9 or so. 66 30 puts. Wait. 68 20. Okay. Folks, don't get old. Do not get old.
That's the number one lesson.
Yeah. So here's about a 17 delta. That's close to 20. So I'm going to just sell the 68 20 puts. I'm 3 days out. And then I'm going to buy the 68 15 puts. So if you look at that right away, you say, Dan, what are you doing? I'm just doing a 5 wide spread on a $6,000 vehicle. You say, Dan, this is SPX. It's going to be too much money. Hold on. So I'm selling a put, buying a put against it. And if I hit view charts here, you can see here, this is about a $60 credit, right? And it's a $60 credit. My max loss is $440. Dan, what do you consider maybe a trade that might be suitable for beginners? Yeah, is a rough guideline, $500 or lower of risk, right? So here, bringing in maybe $60 credit with risk of $440 or so. And this is changing a little bit. Now it's $445 just because this is real prices updating. And so when you're looking at $60 basically on $450, you're talking, Troy, what, about 15%, right? So that's, the number seems small, but it's a smaller trade. And this is a credit spread. And how did you get the risk, Dan? The difference in strikes, this is a 5 wide credit spread, right? And so you have $500 of risk, less your credit will get your max loss. So if the world ends, you're out like $450. If you do it for $50, I'd probably try for $60. So but the one thing I want to point out, just to introduce this topic today, we have a few things to go over, is SPX is at around 6,900. So this is Feb 23, only Monday. So how much room do I get to the short strike? 68.20 or 80 points. Everybody see that? And 68.20, 6,800 has been kind of the lower end of the range this year. And so could we go down 80 points on Monday? We could. If you look at the expected move or what the market expects for Monday, the expected move right now is about $64. So we have a little more room past the expected move. Dan, real quick, you threw expected move. You threw me for a little, what is expected move? It'd be standard deviation. So if I say the expected move for Monday is $64, what am I saying? There's a 68% probability SPX will be up or down 64 points from here at the end of the day Monday. It's a guideline. It's a pretty good number, right? Doesn't mean it can't go further, right? But that's the guideline. But what I want you to, for this conversation, what I want you to remember is 68.20 and above, right? On Monday, we get our check of whatever we get for this, $55, $60, right? Then, if we hold it till expiration, $15. All right, let's compare, right? So what if instead of doing this coming Monday, what if I say, you know what? What if I go 3 weeks out? What if I go to March? What if I go to March March 13, right? March 13 is or March 31, I'm sorry. March 31, let me just see this here. Yeah, March 13, I'm sorry. March 13 is 21 days out, right? So if I just go here, I think I could do it from here without going in the option chain, right, Trey?
Yep.
If I just go 21 days for a vertical, right? I want to show you something. So I'm just comparing a 3-day credit spread versus a 21-day. What are the difference? And if you go here now, if I want to get a similar delta, I can go down to like the 6630 put. So you say, Dan, what are you doing? By going out 21 days versus 3, I get another 200 points to the short strike. Let me say that in Spanish. 200 points to the short strike. So now if we're looking at this on Friday's, this would be Monday's date, when Monday happens. The problem here is, wait till you see, Dan, I don't see the graph real well. It's because we're getting so much room. I had to change the range here a little bit. But you can see now, it's not on something that expires in 3 days, I get 80 points. Here, I'm getting to the short strike from where we're currently at. What is that? The short strike is 6630. We're getting 250, 260 points. It's a different ball game, right? You get a lot of room. So what are a couple takeaways? If you're looking for more, you can't have your cake and eat it too. Both of them are going to be around a $60 credit. So you're saying, Dan, I can do a 3-wide. I can do a credit spread that expires in 3 days and get the same amount as a credit spread that expires in 21 days. Correct. What's the difference? The 3-day gives me 80 points to the short strike. The 21-day gives me 270 points, right? So there's just a trade-off. And so, but going along with Troy's conversation in the morning with range bounds, with the higher volatility, what does a higher volatility mean for credit spreads? It doesn't necessarily mean that you get that much more credit. You can, but it gives you more room. Right now, we're at a 19 volatility. So just give you an example. With a 19 volatility, we're getting all this distance to the short strike. If the VIX was lower, if volatility were lower, like 14 or 15, you're not getting anywhere near this room to the short strike. You're getting probably less credit and not enough room. So I just wanted to kind of throw that out there. But again, if you're a smaller trader, could you trade SPX or SPY? Would be even cheaper. Yeah, but if you do a 5-wide credit spread in SPX, you're talking about a $440 trade. So, that's at least a stab at this. We'll come back at this, but I wanted to go over a couple of things. Troy, any thoughts on this before I go to butterflies? I'm trying to stab.
No, I think it's the way to look at it is you're what Dan just said. You're keeping the credit the same, but you're getting more room, right? That's kind of the nature of the game with SPX. And so, yeah, it's just, is it safer? Statistically, yes. Your risk is, risking 435 to make 65. Well, why would you do that? Because the probability is in your favor.
Yeah, that's it. You give up. In one aspect, you could say, well, Dan, for a 0-day, I'm getting about the same credit. And the other way to rightly look at it, for a 0-day, and this is important to bring up, the expected move to Monday is 65 points. The expected move 3 weeks out is 246 points. So it's just saying, if we had a move on Monday, right, a 100-point move on Monday, it would negatively impact the 3-day credit spread much more than it would the further out one, right? Because you have a lot of room to the short strike. So just this is kind of just to get a feel of what does a credit spread look like? What does it cost in SPX? What are the differences between a short duration and a long duration? And what is a higher VIX level mean? It means you get more room and a little bit less credit. But this is, kind of a popular strategy, doing credit spreads, right? And some people historically do credit spreads in stocks you like or whatever. But this is this. And then, so let's move real quick to, I'm going to take a detour, spend just a couple minutes on I'm going to go to USO, right? Say, Dan, why are you USO? Well, people are looking at oil the last 3 days because, right, Trey, there's a country called Iran, right? That there's some stuff going on, and people are looking at, oil prices have been going up, right? And so what if you wanted to say, hey, Dan, I like a little thrill, right? Because you don't want it to be like with range-bound trades. Troy, what was the famous blues? Who did The Thrill Is Gone, Baby?
BB King.
Yeah, BB King would say, if the thrill's gone, you need a little bit of thrill. Now, why isn't bringing?
So go to chain. Go to chain.
Oh, I didn't go to chain.
Okay. No, you're good. Just go down. Go down.
Oh, yeah.
Where USO is. Where USO is to the right. Yep.
Yeah. Oh, chain. Chart, chain. Okay, here we go. Thank you. So if I go to chain and you say, okay, again, for a beginner, is it okay to do speculative stuff? Yes, but again, the number one, number two, and number three things to consider as a beginner is size. Size. Keep the size small, so small that you get what's going on, right? And you're starting to learn, but you're not going to get discouraged by having, hey, I put a $5,000 trade on. Well, what the heck you put in a $5,000 trade? So let's just say we're going along and we say, you know what? Let's say in USO, I think, what if you think there's going to be something with Iran next week? And you're saying, okay, I want to take a shot. And if I'm a beginner and I'm doing a 5 range bound trade, right? Just to give you an idea of sizing, I don't want to spend more than $100 on a spec trade. Dan, can you do that? Yeah. USO is an $80 stock. And again, USO, in the last 3 days has gone from 75 level to 80. Why? Well, there's some rumblings going on in the Mideast. So if you look at USO, and let's bring up a Feb 25 expiration. So that would be next, Feb 25 is in 5 days. And so what is a cheap shot for the upside that we can participate? And so we don't have to sing the song, A Thrill Is Gone by BB King. So I just looked at one, and let's just say we buy, this would be a butterfly, just to get an unbalanced butterfly. So why don't you just see what I'm doing, what this dance is. I'm going to buy one. So this is 5 days out, right? 5 days out will be next week, Wednesday. So I'm going to buy one of the 81 calls. Those are slightly out of the money. We're at $80.42. All right. And then I'm going to sell two at the 83 strike. I don't have to do that. Sell two at the 83 strike. Now watch this. So the distance between my long and my two shorts is 2. So now I'm only going to go one wide here because I want to be a little bit bullish. and I'm going to go buy this call. So this would be a broken wing butterfly. I'm buying the 81. A butterfly is buy one, sell two, buy one. You can do it balanced, right? Balanced would be buy 181, sell 283s, buy 185. Here is unbalanced. The distance from my short to my lower long strike is 2. The distance from my short strike to my upper strike long is 1. And so when we look at the graph on this, I am 9 deltas long, right? It'd be like owning 9 shares of stock. As we go up, I make $9 roughly. But you can see the graph here. This looks nice on the upside. And does it fit the beginner mode? This is $36 trade, right? This is a couple lunches at Panera, right? And maybe if you add a latte with that, which I don't really understand what a latte is. But here's the thing. You can see here, if by next Friday we're in this profitable area here, yeah, you could make 50 or $100, right? On a $40 investment. So at least hey, you can make 100% if we're in this range. And if you're wrong, you're out $40. So what's the importance of spec trading? The importance of spec trading is your size, right? And so you could see as we get closer to expiration, let me just show you this, as we start getting, here's Monday, Tuesday, it expires Wednesday of next week, the sun rises in that graph area. And, that's, you can really hit one there. What do you mean hit one? Like hit a home run on $39, you can, make $100 or something. Now, but if you're wrong, right? Cheap shot. And on a speculative trade, you should only play with what you're willing to lose. And again, if you're a beginner, I think you should be playing with $500 trades till you, just my opinion. I'm not saying that's not flexible depending on your experience, but if I'm using $400 or $500 trades for range bound, the spec trade should be much smaller to get used to that. Now, last thing, I'll delve in. I should be able to do this in 7 minutes, and Troy will be impressed because I'm long-winded and I don't always be able to do this. So let's go.
It's always wisdom, though. It's a lot of wind of wisdom.
Yeah, I don't know. Thank you, Troy, but I don't think so. With me. Let's see. So I go to XPX, and if we go to the chain, I'm going to go in this concept of, again, we just talked about butterflies. Now I'm going to throw a balanced butterfly at you. And again, just diversifying your durations a little bit. So on this example, I'm going to go out to March 13, which is 21 days out. So let's go to 21 days out. And I'm going to create a beginner butterfly that you can get your feet wet, right? So I'm going to go to we're at 68.90 or so in the SPX. Let me double check. Yeah, we're at 68.90. Got to go up here. And so let's say, and this is going to be you'll see a little bit short delta. So I'm going to go a little bit above where we're trading at. We're at 68, what did I say? 68.80, 68.90. So let's just say we go to, where do I go? Let's say at least 20 points above the market. And we're going to go 50 wide, right? So let me just show you what this looks like. So I'm going to sell. We're around in that 68.85, 68.90 area. I'm going to go a little bit above the market, 69.90. And I'm going to sell 2, right? So how did I pick the short strike on this balanced butterfly? I want about 20, 30 points above the market. 20. I sell 2. I'm going to go down 50 points from here. 69.90 minus 50 would be 69.40. Buy. And then I'm going to go 50 points above my short strike of 69.90. So I'm going to go to 7,040. Right? And that's a balanced butterfly 50 wide. From the short strike to the in the money call to the out of the money call be 50. If we go real quick and hit the view chart, All right, there we got it, right? The underline is that you could see here 68.80. Our short strike is 69.10. 60, what do I got? 69.90 is our short strike. I got this. Let me just see where we're at here, Troy. 69.90 is our, oh, I'm way above. Okay. Let me,
you went to the you went above on both of them. So you go. Oh no, you're right. I'm sorry, you did it right.
no, but I went too far. So we're at 68.80. This is good. So let's say I go 20 points above where we're trading at. 68.80, add 20 points. So that should be 6,900, right? Then go 50 points down. So that would be 68.50. And let's go 50 points up, 69.50. All right, that should be good. So you've got 68.50, and it should readjust. Let me just see whether I got it right. 68.50. Okay. Don't, folks, I'm going to tell you this again. Do not get old, right? 68.80. So I want to sell the 6,900. All right. So this is just fat fingering it. 6,900. So I'm going to sell my short 20 points above, go 50 points down from there, 68.50. And then 50 points above the short strike, which is 69.50. That should do it. All right. So there you go, folks. You have, we're at 68.80. I'm putting the short strike 20 points above market, and I'm 50 points wide. And you can see this is $375. Fits it. I'm one delta short. So we can go down probably 150, 200 points down from the current price. And you can see it's all green, short term, right? And then on the upside, volatility will come down. You'll be fine. But it's a balanced butterfly, right? You say, Dan, why are you placing the short a little bit above the market? Because I'm short delta, on the downside, I can handle a lot of room, right? But on the upside, right, I can't handle as much as I can on the downside. So to make up for that, I'm just starting my short strike, right, a little bit above it. And if you look at this, folks, as we start going over time, right, the green, but you can see the green is more prominent on the downside until we get some duration. Now we're out to March 3rd, and you can see it start rising like that. But this is a good trade that we like, that I like a lot, when the VIX is a little bit higher, 19 or 20, because it's just much stronger butterfly that can handle the downside. Because when you're at 19 or 20, right, Troy, we're getting more downside, right? Period. So this is the type of butterfly we use on the downside. Now we might go 70 wide or 100 wide. Some people will do. Why am I saying 50 wide? Because it's cheaper. It fits more beginner. If you're a little more experienced, you could do much wider, but it's going to be costing much more. Now, this is a little short. And when the deltas in the market, Troy's got a minute here. We got a minute here, but you can see the deltas are short. If the VIX started coming down, and if VIX is 19, we're getting more down days, right? And more in VIX 20. If VIX is 15 or 14 or 16, you're getting more up days. Then I would go from maybe a 70 wide, you can see this, to this, where I would take my upper strike long, right? If I come in 10 points, that was 69.50, go to 69.40, excuse me, 69.40. Okay, now you see, well, wait, Dan got us, what was that, 50 I'm going to go 45. 45. So this is 50, 45, right? When VIX is lower, now I'm basically neutral, close to neutral, and this is more palatable for the upside, and I can make this at the money. But a lot to think about, folks. But again, here's the key. Here's the key. Let me just leave you with this. As you're learning these things, can you just learn it from the book? Can you just learn it from words? No. And if you keep the trade small or paper trade, right? And you can do paper trade in the modeling, right, Troy? You can just save the model.
100% just save the model, watch it.
But I don't see how you can learn, beginners can learn without, okay, here's the strategy butterfly. Dan talked about this. Go in the modeling, create one, watch it over the next week, right? But people try to understand things without doing it. Anyways, next week, I'm not sure. I've got an idea which direction I'm going to go next week, but we'll get more experience, do some repetition, go over stuff. Have a wonderful weekend, folks. We will see you next week. Thanks again, Troy.
Thank you, Dan. And listen, we're going to be packaging together some of the real stuff we've been talking about. Be looking for those videos in the coming weeks. So if you want to review the will, we'll go from there. And then hopefully, Monday, Dan, VIX opens at 200 and we can really start learning some high vol plays,
Yeah.